Welcome to Accounting 101 Synchronous Seminar for Chapter 10, Stockholders' Equity. This chapter is going to talk about the different learning objectives that relate to stock. The first objective is to explain the features of a corporation. Second objective, account for the issuance of stock. Third objective, to show how Treasury stock affects a company. Fourth objective, account for retained earnings, dividends, and splits. Fifth, to use stock values in decision making. And number 6, report stockholders' equity transactions in the financial statements. You should always have read your chapters before you attempt your homework. Make sure that you read about the spotlight companies in this chapter. It's Home Depot, and they have a representation of their consolidated balance sheet to give you an idea of what the stockholders' equity section would look like on a real company's financial statements. One of the things that I try to point out is that as we've worked through this book, we start with Chapter 1, where we do an overview of the financial statements and what financial accounting is all about. Chapter 2, we start through the transactions, and Chapter 3, we go ahead and look at adjusting entries and closing entries as we have completed the accounting cycle. Then we step back and we start going through the financial statements and looking at them in a little more detail. We look at how cash is affected. We look at the internal controls that need to be related to cash. We look at our bank reconciliations. How does that play into having more adjusting entries and items like that? We move on through. We take specific looks at current assets. We look at inventory and cost of goods sold, and how do we calculate that, and how does that appear in the income statement for your cost of goods sold and on the balance sheet for your asset section. We go on to look at long-term assets, which are our fixed assets, our plant, property, and equipment, and also intangibles. We move on and we look at receivables. Long-term receivables and investments, and how do those affect our balance sheet, and how do the interest accruals affect our income statement. We've continued on to Chapter 9, where we took a look at liabilities. We took a quick look at how payroll liabilities affect our balance sheet in their current liability sections. We looked at how bonds, which as a long-term liability can affect. We looked at amortization of that bond interest to see how that affects our income statement and our balance sheet. And now we're to Chapter 10. So we've basically covered the stockholders or the asset section of the balance sheet and the liability section of the balance sheet in more detail up to this point. And now we're going to cover the stockholders' equity section in more detail. So let's get started. The first objective was to explain the features of a corporation. This should not be totally new information to anyone. It should be items that we have learned. We talked about both in the beginning of this book, and if you've had Business 101, you've probably talked a little bit about how corporations operate. You may have touched on it in a business law course. But at any rate, there are some certain features of corporations that have advantages and disadvantages for this company. First of all, we might look at the advantages, which are they can raise more capital than a proprietorship or a partnership. This is because they can sell stock. They also often have more assets, so they can borrow more against those assets. They can come up with bond issues. They have a continuous life. If you have a sole proprietorship and the owner dies, that business as it is no longer exists. If you have a partnership and one of the partner dies, that partnership is dissolved. You would have to form a new partnership with a different owner. You could still keep the business going as a DBA, but your ownership would change. The ease of transferring ownership. If I want to sell the ownership of my shares of stock, I just sell them. I don't have to have an auction or anything like that. I can just transfer stock, or if I want to gift stock to my children or to anyone, I could do that. The transferring of ownership is very easy. And the limited liability of stockholders, if I own shares of stock in a company, you can't come and sue me and take away my home or any other personal assets I have. If I'm a sole proprietorship, any of my personal assets are at risk as well. Disadvantages include separation of ownership and management. Who hires the management of a corporation? Well, that happens to be the board of directors. So the board of directors is put into place, and then they hire the CEO or the head person of the company. Then that person proceeds to hire all of the people that works for him. So that can be seen as a disadvantage. If I'm a major stockholder or have majority, I do not have control of the management. I am a member on the board perhaps, and so I have control by who I hire as the top person, but nothing after that. Double taxation of distributed profits. What does that even mean? Why do we say that that corporations are double taxed on their profits? Well, notice here that it does say distributed profits. That means that any items that I pay out in cash dividends are taxed again at the individual payer's tax rate. So if I'm a stockholder and I got $20 in dividend from a company, the company had already paid their income tax percentage on that money, and then I as an individual would pay my tax rate, income tax rate on that $20. So if I'm in the 10% tax bracket, I would pay an additional $2 on that $20, whereas the corporation is probably paying a 30% tax rate, so they would have already paid taxes out of that to get to the $20 to have to distribute at a rate of 30%, which is huge when you stop and think about it. There's lots of government regulations for corporations. So they have to have the SEC review all their financial statements. If they are trading stock on the open market, then that is regulated. So lots of government regulation costs more money. You have to have more professionals to watch over your legal and financial operations. If I want to organize a corporation, we get a charter from the state. You do not have to incorporate in the state that you're doing business in. There are advantages to incorporating in states that have the lowest corporate income tax. So the charter includes an authorization to issue shares of stock. If I am going to incorporate, I must pay fees. We must sign the charter. We file documents with the state, and we agree to a set of bylaws. We have to hold at least annual board of directors meetings. Minutes must be kept on those meetings. To look at a structure of a corporation, the stockholders elect the board of directors, as I said earlier. The board of directors elects the CEO, and they may elect the COO, the president of the company, and then those people lead and hire all of the middle management and lower management underneath that. Stockholders' rights. You have different rights depending on the class of the stock that you have. If you want to vote, the right of voting on matters that comes to before the stockholders, those must be common stock, by the way. Preferred stockholders do not have the right to vote. Stockholders have a right to receive a proportionate part of any dividend that the company declares, but keep in mind that a company does not have to pay dividends. If the company must liquidate, they have a right to receive a proportionate share of any assets remaining after the corporation pays its liabilities in the liquidation. So if a company had $100,000 left and you were a 10% stockholder, then you would get $10,000 at that point in time, and then your stock would have no more value. And a preemption right means that they have a right to maintain one's proportionate ownership of the corporation. So if there are stock splits or stock dividends, those need to be given in a way that you have that right to keep the same proportion of ownership. Stockholders' equity. There are two sections to stockholders' equity, and I'm going to go ahead and pop this up because I think it may take a while for it to load on different screens. Paid-in capital, it's also called the contributed capital. That is the amount of equity stockholders have contributed. This would include any stock accounts and any additional paid-in capital. Retained earnings are the increased earnings through the profitable operations of the business, and it is reduced by dividends paid out. So we've seen how retained earnings increase by looking at the statement of retained earnings. Beginning retained earnings plus net income minus dividends equals ending retained earnings. There will be a few problems in your assignments where you need to remember how retained earnings is calculated and know that you need to add net income to that to get the correct answers on the assignments. This is an example of a stock certificate. Every stock certificate will have a par value. Par is an arbitrarily stated amount that comes up to the legal capital of the business. We'll talk about that more as we move forward. It'll have the company name, the stockholder's name, and the number of shares that stockholder owns. As I said earlier, the common stock will have the voting rights, but common stock is the basic form of stock. If a company only has one class of stock, it will be common stock. Again, it has 4 basic rights, which we will talk about as we move on. The shareholders benefit most if a corporation succeeds, and the common stockholders also take on more risk because they are the last ones to receive money in case of liquidation. Preferred stockholders, the different advantages include they would receive their dividends first. They receive assets first in case of a liquidation. The shareholders earn a fixed dividend. It's a guaranteed dividend if any dividends are distributed or declared. And very few corporations actually issue preferred stock. Preferred stock costs more if they do issue it. So as we see in an illustration on the slide now, or Exhibit 10.4 in your textbook, you can see that only 9% of corporations have preferred stock at all, while 91% have only common stock. One of the things to think about is what is the difference between issuing stock and borrowing, like issuing bonds or borrowing a long-term note. And with common stock, you do not have to repay it. Dividends are not tax deductible, and you only have to pay them after obligation, after the declaration. Once they have been declared by the board of directors, that you are obligated to pay. Same with preferred stock, but with long-term debt, we must pay that money back. There is interest. The interest is tax deductible, however. It will reduce your amount of taxable income. And you have to pay the fixed rate and date. You have to pay that interest as it comes due. So what is the difference in par value and no par value? As I said, you heard me mention that par value was the arbitrary amount assigned to the share of stock. These arbitrary amounts that are assigned are usually set to a low amount to avoid legal issues. Most states do not allow companies to issue stock below par. So if I had stock with a par of $10 and the market bottom fell out of the market, I could not issue stock at $8 a share. So if I make the price of my stock $1 par or a penny par or half a penny par, then I can issue it at any price I want above that. And so it's less likely that I'll run into trouble selling my stock. You can have no par stock. No par stock can have a stated value or it may not have a stated value. So if you come across a transaction that asks you to issue no par stock, then you just issue that stock at the amount of cash you were paid for that stock. Another thing that I might say is issue stock. When I say issue stock, that means the company has sold that stock. They have so many shares of stock authorized when they get ready, when they do their articles of incorporation, when they get their charter for the corporation, they have a X amount of stock, a X amount of par value to get their legal capital. So how do we go ahead and do the journal entries or account for the issuance of stock or the selling of stock? Home Depot, in this example, needs to raise $100 million through the issuance of stock. If we have Home Depot's common stock had carried a par value equal to its issuance price of $10 per share, the entry for the issuance of the $10 million shares of stock at par would be, so this is $10 par stock that was sold for $10 a share, and so the company would receive $10 million times $10 or $100 million in cash, and in that place they have issued 100 million shares of common stock. Not 100 million shares, but $100 million worth of common stock. If the stock was only had a par value of 5 cents, then the entry to issue the same 10 million shares of stock at $10 would be the 100 million cash. We get the same amount of cash, but the common stock dollar amount is only 10 million times the 5 cents or 500,000, and the paid in capital then that's related to that would be the $99,500,000. So you can easily figure your common stock amount. You should be able to figure the amount of cash by how much cash you received. And the paid in capital is the difference between those two accounts because your debits must equal credits in every transaction. Notice here that we are getting cash, so it is a debit. We are increasing the amount of outstanding stock, so an increase to a stockholder's equity account is on the credit side. And we are also increasing our paid-in capital, which is a stockholder's equity account credit. So if we wanted to look at how this would appear on the balance sheet, one way it could appear is we have our common stock. We will list the par amount, the 10 million shares that are authorized in our charter, the 10 million shares that we just issued, and the issued shares are outstanding. The outstanding shares are the shares of stock that dividends would be paid on. We add in our paid-in capital to get our total paid-in capital section of the balance sheet. If their retained earnings were $500 million, then their total stockholders' equity in this case would have been $600 million. If it were no par stock, there was no stated value on the stock, and for example with Apple here, they issued 939 million shares of no par common stock for $16,422,000. Apple stock issuance entry is cash, the 16,422 million. And common stock, 16,422 million. Because there were no par, we do not show a paid-in capital. An example of how that would appear on Apple's sheet. Occasionally, a business will issue common stock or stock for other assets rather than cash. This is an example of a company Icon Corporation issued 15,000 shares of its $1 par common stock for equipment with a market value of $4,000 and a building with a market value of $120,000. Equipment increases on the debit side, so we would record our equipment with their market value at $4,000. Our building had the market value of $120,000. Building is an asset, increases on the debit side. Common stock, we said that we issued 15,000 shares up here. Let me see if I can get my marker. We issued 15,000 shares. Guess not. So here's our 15,000 shares for $1. Okay. So that's our amount of stock, 15,000 times $1. And again, the paid-in capital in excess of par is going to be the 124, these two numbers added together, minus the 15,000 to get the 109. So we do the math to get to that number. If we provide stock for an expense, in this case we provided stock to an attorney. The attorney bills the corporation for $25,000 for services and agrees to accept 2,500 shares of $1 par common stock rather than cash. So the fair market value of the stock is $10 per share on the day that this transaction occurs. So the legal expense is $25,000. The common stock, the par, they got 2,500 shares at $1 for 2,500 shares. And the paid-in capital in excess of par was $22,500. I'm going to pop up an Excel sheet here real quick. I want to look at something. So you could also take the $2,500 shares of stock times 9, which is the difference between the fair market value and the dollar, and still get the $22,500. Preferred stock follows the same pattern as accounting for common stock. You must have a separate account for preferred stock and for the paid-in capital between the two accounts. And we can issue preferred stock with a conversion feature, which at some point in time we would allow shareholders to exchange preferred shares for common stock if they so choose to do so. So if we had convertible preferred stock, we sold convertible preferred stock at its par value of $1 per share, and we sold 50,000 shares, we would receive $50,000 in cash, and we would record our convertible preferred stock at $50,000. If it was then converted, they took advantage of the opportunity to convert to common stock, and this was done at a rate of 6.25 to 1. So you would take the 50,000. This 8,000 is the 50,000 divided by 6.25. That's how you get the 8,000. Okay. And again, the difference is your paid-in capital in excess of par for your common stock. So more terminology here. We need to know what the difference is between authorized, issued, and outstanding stock. We pay shares. If we pay dividends, we pay it on outstanding stock. Authorized, it's the total amount of stock that was authorized to be issued under the charter or the articles of incorporation. The issued are the stock that have been sold or issued to its stockholders, and the outstanding is the number of shares that stockholders own. These are the number of shares that are actually in the hands of the shareholders. So this becomes important because as we move forward and we talk about Treasury stock, Treasury stock is stock that has been repurchased by the company, and it's not counted as outstanding stock when you get ready to pay dividends. Objective 3, show how Treasury stocks affects a company. So Treasury stock is previously issued shares of stock that have been reacquired by the company. The company may do this because they want to do an employee stock purchase plan and they don't want to give up more ownership of the company. They may do a plan to buy the stock low and sell it at a higher price if the stock is trading low. They might go out and purchase up this stock and then wait for the price to go up and then resell it and make some money that way, additional paid-in capital that way. This can happen to avoid a takeover if there's lots of shares of stock out there floating around and they get wind that someone is going to try to buy up enough stock to gain the majority share so that they can control the company. They may go out and buy up stock. It can increase your earnings per share. The less shares of outstanding stock I have, the higher my earnings per share, because the earnings per share is net income divided by outstanding shares of stock. And we can also use in a share of a repurchase program. One thing that you would want to caution about is that you've all heard of insider trading, I'm sure, and you want to make sure that if you're doing this buy low and sell high, that you as a company do not have knowledge that you're getting ready to come out with some super fantastic new product or something that would make your price go up. You cannot have a calculated buy low and sell high. You want to appear above the board with that type of a thing. So how is Treasury stock recorded? We record it at cost, not at par value. So if we go out and we do a repurchase of our own stock, whatever we pay for it is what we record it for. This is also an interesting classification. It is classified as a contra stockholders equity account. Therefore, it has a normal debit balance. It will reduce our stockholders equity. So the following entry records a repurchase of 74 million shares for $4 billion. We just debit Treasury stock for the $4 billion and credit cash for the $4 billion. This entry is about as straightforward as it gets. So how does this appear when I'm looking at my actual stockholders equity section of the balance sheet? It will appear down here. My Treasury stock is going to appear down here below my retained earnings as a reduction to retained earnings. Notice it's a reduction, right? It's not listed up here with my stock. Other classes of stock. If I want to retire Treasury stock, we have repurchased it and we never plan to reissue it again. We can cancel those stock certificates, meaning we can't sell it again. Once the shares are repurchased, neither total assets or total liabilities are affected. And the memorandum entry made to decrease the number of shares issued in the stockholders' equity. We just have to know how many shares we will not be issuing again. So then think about the resale of this Treasury stock that we purchased back a couple transactions ago. It increases assets and equity, right? When we resell it, we will get cash, and our equity will go back up because we will be crediting the Treasury stock, and a debit. It has a normal balance of debit because it's a contra equity account. So there's no gain or loss on transactions involving Treasury stock. We don't record gains and losses. Any amount that is received in excess of the amounts originally paid for that Treasury stock are recorded as a paid-in capital from Treasury stock transaction. So just like we have a paid-in capital for a common stock, we have a paid-in capital for our preferred stock, we have a paid-in capital for a Treasury stock transaction. Any amounts that are received from the resale of Treasury stock, less the amounts originally paid, are debited to the paid-in capital from Treasury stock. Transactions to extent of that balance, and after all, to retained retained earnings. What does that mean? Amounts received from resale of Treasury stock less than amounts originally paid are debited to paid-in capital. Normally, we would be crediting paid-in capital. So if we sell it for more than what we paid for it, we will credit paid-in capital. If we sell it for less than what we paid for it, we would debit paid-in capital related to those stock transactions. So we will occasionally have a debit entry to this. Okay. Here's an example of reselling Treasury stock for $55 when we originally paid $54.05 for it. So in this case, we will credit our paid-in capital from Treasury stock transactions because we sold the stock for more than what we paid for it when we repurchased it. So here's another little illustration that we can look at. At December 31st, 2014, Harnett Corporation reported the stockholders' equity as follows in millions. Common stock of $1.50 par value per share, 2,400 million shares were issued. They had a paid-in capital in excess of par, retained earnings. They had Treasury stock, which they have recorded at cost, again as a negative number. And then they have their total stockholders' equity. Their transactions included, they issued 16 million shares of common stock for $10 per share. They purchased a $6 million share of Treasury stock for $100 million, and they sold $3 million of the Treasury stock that they purchased in Part B for $70 million. So what would those transactions look like? The issuance of the 16 million shares of common stock is going to be cash, common stock, the 16 million at the par value, and the paid-in capital in excess of par for that common stock, the difference between the amount of cash received and the common stock account. The second transaction, we repurchased 6 million shares of the Treasury stock for $100 million, and the sale of 3 million of the Treasury stock repurchased in Part B. So we bought Treasury stock. We have our cash. And then we sold part of that Treasury stock for more than what we paid for it to get paid-in capital from the Treasury stock. You'll notice that we are messing with the title of these paid-in capitals a little bit as we go through this. Like some of them might just say paid-in capital, some might say paid-in capital in excess of par, some might say paid-in capital common stock, some might say paid-in capital from Treasury stock transactions. That's because whatever your company's name for this account is in the chart of accounts is the name that you would use. And then when they issued 21 million new, not Treasury shares in conjunction with an employee stock compensation plan, then it becomes a compensation expense instead of cash, and common stock and paid-in capital. The only thing that changes is that we're not issuing cash for this or getting cash for this. It becomes an expense, and expenses increase on the debit side. Again, we are representing another balance sheet. And how do we account for retained earnings, dividends, and splits? You have to remember, and I said this earlier too, that retained earnings plus net income or minus net losses less any dividends equals the accumulated amount of retained earnings over the life of the business. If it has a credit balance, those are the lifetime earnings of the business, and it has to be greater than the lifetime losses in the dividends that have been paid out. If it has a debit balance, it means your lifetime earnings are in the hole, basically, and we have had lifetime losses and dividends. How do we know when a company should declare and pay cash dividends? These are distributed by the corporation to its stockholders, usually based on earnings, and they take one of three forms. They are either cash dividends, stock dividends, or non-cash assets that are provided. To pay cash dividends, it's important to note that a company must have both enough retained earnings to declare the dividend and enough cash to pay the dividend. I cannot pay out $1 million in dividends if my retained earnings is $500,000. I mean, it just can't happen, and I can't pay out $1 million in dividends if I have $100,000 cash. The board of directors has the authority to declare a dividend. The company is not obligated to pay a dividend until the board of directors declares a dividend, and there are three relevant dates when we are going to do dividends. There is the declaration date. This is the date that the board of directors declares that there's going to be a dividend. There's the date of record. So when they do a declaration of dividends, they will say something along the lines of, we will pay dividends we're going to pay 10,000 dividends out to the stockholders of record as of January 31st, 2014. So if I owned stock in the company on January 31st, 2014, I would get a dividend. If I sold stock the day before and I'd owned it for years and years and years, I would not get a portion of that dividend. And then there's the payment date, the date that that is actually made. What do the journal entries look like to do this? Well, the day that we declare a dividend, we will debit retained earnings for the amount of the dividend and credit dividends payable. We just put a current liability on the books when we debit dividends payable. You will notice that that increases our liabilities, decreases our stockholders' equity. We haven't seen these little puppies for a while, of where we've come back and looked at how every transaction affects the accounting equation, but that's what we're looking at here. When they pay this dividend on July 10th, we will debit dividends payable to reduce or zero out that liability, and we expend the cash at that date, so we have a credit to cash. A little T account, looking at the ledger of the retained earnings, we had a beginning balance of $17,246. We had net income of $45.35. We paid out dividends of $17.43 to give us an ending balance of $20,038. And as I said, it's important that you remember that you have to do this when we are working on our homework. Here's another illustration. They want us to journalize the transactions to record the declaration and payment of cash dividends of $32 million for the Harnett Company. The declaration is going to be retained earnings, debit, dividends payable, credit. To pay those, it will be dividends payable, debit, and cash, credit. How about dividends on preferred stock? I said earlier that the dividends on preferred stock are guaranteed amounts if a dividend's paid. So typically, dividends are stated as a percent of par value or a dollar amount per share. They may be cumulative. This means that past dividends are owed to preferred stockholders. You hear the term in arrears. If we had dividends in arrear, then we must pay those back. And a little side note here, that is just almost like debt, right? So if I haven't paid dividends to the last 5 years to my cumulative preferred stockholders, then I must go back and pay those if any dividend is declared. So here's an illustration of where we have stock of Avant-Garde Inc. It is cumulative stock. They passed the preferred dividend of $150,000 in 2013. Before paying dividends to common stockholders in 2014, they must first pay the preferred dividends of $150,000 for both 2013 and 2014 for a total of $300,000 before they can pay dividends to the common stockholders. As you can see, this could greatly reduce the amount of dividends a common stockholder received. Here's another little illustration for you to stop and think about. Arizona Manufacturing reported the following at December 31st, 2014 and December 31st, 2015. They had preferred stock cumulative, $1 par, 6%, 90,000 shares issued. They had common stock, 30-cent par, 9,130,000 shares issued. Okay. They have paid all of their preferred dividends through 2011. So compute the total amounts of dividends to both preferred and common for 2014 and 2015 if the total dividends are $90,000 in 2014 and $270,000 in 2015. So first you need to determine how much do we need to pay the preferred stockholders that were cumulative and arrears. So they were paid in 2011. The amount is 6% per dollar, so that's 6 cents per share. So we would need to do 90 cents. So a dollar. Let me pop up my calculator here again. Really, it's not a calculator. Let me pop up my Excel sheet. Okay. So as I pop up Excel, because I am truly an Excel user, and we said we had a dollar par stock. It was 6%. And I told you it was 6 cents, but we'll just do that transaction here. 6 cents per share, and we have 90,000 shares. So I'm going to take my 90 times my 6 cents per share. So for each year, that would be $5,400. So I need to go back and I need to pay it for 2012, 2013, and 2014. So that's 3 years. My preferred stockholders would get $16,200 of that 90, which leaves $73,800 for my common stockholders. Now in 2015, I'm not in arrears any longer, so it was the $5,400 that we computed for the preferred stockholders. So the common stockholders would get all of the dividends with exception to the $5,400. Or $275,400. Oh, I did 3 years instead of 2 on my calculation, but 2 years times 54. Okay, example. So stock dividends. These are proportional dividends or distributed to stockholders. So if I have 10% of the shares of stock in the company, again, and they issue 1,000 more shares of stock, I am going to get 100 of those shares. It increases the stock account and decreases retained earnings. The total equity is unchanged. Why would we do a stock dividend? We may want to continue dividends, but conserve cash. And this would also help to reduce the market price of shares, which would again help our shares start selling again if they have kind of gotten stagnant. The size of stock dividend, if it's 25% or less, it's recorded at market value. If it's greater than 25%, we record it at par value. Stock splits. What's a stock split? You've probably heard of stock splits. This would mean if you might hear of a 2-for-1 split or a 3-for-1 split. So if stock has a par value of $1 and you have a 2-for-1 split, it becomes worth 50 cents. So if I had 1,000 shares of $1 par stock authorized, then I could issue 2,000 shares of 50-cent stock. If it was a 4-for-1 split, that dollar stock would become or dollar par value would become 25%. It does not affect any of our accounts. We do not have to do a journal entry. It does decrease the market price of the shares, and it also would require a note to the financial statements to state what we had done with our stock. So a summary of some effects of stock transactions on assets, liabilities, and stockholders' equity. If we issue common stock, we have increased our asset typically. It's no effect on liabilities, and we've increased our stockholders' equity. If we purchase Treasury stock, we've spent cash to do that. We have decreased our assets and decreased our stockholders' equity. Remember, I said Treasury stock increases on the debit side because it is a contra stockholders' equity account. If we sell that Treasury stock, we increase our asset and increase our stockholders' equity. Declaring a cash dividend increases liabilities and decreases stockholders' equity. Paying that dividend decreases our assets and decreases that liability. So we zero out that liability and we have less cash. Stock dividends have no effect on our financial statements and no effect on a stock split. Also has no effect. So how do we use stock values to make decisions? If we are doing market, redemption, liquidation, and book values, these are all the different values of stock we can look at. The stock's market value, or the market capitalization, is the market price multiplied by the number of shares outstanding. The overall market assessment is the worth of the share of common stock is reflected in the price-earnings ratio. The price-earnings ratio is actually the market price of one share of common stock divided by the earnings per share of common stock. This has become the go-to ratio to look at if you want to invest in stock, the price-earnings ratio. The market price of one share of common stock divided by the earnings per share of common stock. Redeemable preferred stock requires the company to redeem the stock at a set price. A liquidation value is the amount that a company must pay a preferred stockholder in the event the company goes out of business. A book value per share of stock is the amount of common stockholders' equity on the company's book for each share of its stock. That would mean you would add the common stock plus the paid-in capital account related to that common stock and divide it by the number of outstanding shares. The relating profitability to stockholders' investment, the ROE formula. This is the DuPont analysis. It provides a way to analyze various elements of profitability as shown in the following diagram. You are not expected to memorize this. You do not have to have it memorized for your final exam that is proctored. It's the ROA times the leverage ratio equals the ROE. You take your net profit margin ratio times the asset turnover times the leverage ratio to get your return on equity. Net income minus any preferred dividends. Don't get caught up in this. If you don't have preferred stock, you will not have preferred dividends. It's just net income then. You don't have to make up a number for preferred dividends. Divided by net sales times your net sales divided by average total assets times your average total assets divided by average common stockholders' equity. Okay. And that equals your net income divided by average stockholders' equity. That will help you to come up with your return on equity. And how do we report these stockholders' equity in the financial statements? For the statement of cash flows, these are all financing transactions. They affect both cash and equity, right? These include the issuance of stock, the Treasury stock transactions, and the dividends. If I issue stock, then my cash goes up in my statement of cash flows. If I buy Treasury stock, my cash goes down. If I sell Treasury stock, my cash goes up. Pay dividends, my cash goes down. next chapter is the statement of cash flows, and it'll make a little more sense maybe to you at that point in time. And we just are looking here at Home Depot's consolidated statement of stockholders' equity. Looks pretty busy, huh? And then a detailed look at stockholders' equity section. Okay. And that's the end of the slide presentation. Does anyone have any questions? I've gone through these slides pretty quickly. I wanted to take a little bit of time tonight as well to look at a quick problem in my accounting lab here that maybe will help you when you get ready to do your homework. So this is problem 1068 out of your textbook. I can't really make this big for you to see, but you could go to your study plan and open problem 1068A. And I just wanted to show you a little bit how you have to pay attention to both data tables here and what we need to know. It says, first of all, we sold 6,400 shares of common stock for $10 per share. We got cash, right? 64,000. How do we know how much to record in common stock? We have to look at our common stock account in our balance sheet and see that we have $8. That is $8 par stock. So that's the 6,400 times $8. And then the difference is the paid-in capital. I wanted to point that out, that you have to know, be able to look over here and see what your par value is. That was kind of something that can trip students up. The other thing, I'm going to just go ahead and show my problem here, which you don't have that magic button, but it's nice that I do. So as we look at this then, and we scroll on down, the second one, we declared the regular cash dividend on the preferred stock. Well, we had to look over here and see that our preferred stock pays a 50-cent per share of stock dividend, and that we have 900 shares issued. So it's the 900 times 50 cents to get the 450. So again, you have to know to look in the balance sheet to get that information. We paid that cash dividend, so we just paid it. We distributed a 10% stock dividend on the common stock. The market price of the common stock was $15 per share at the time that we did that. Well, originally we had with our common stock, we had 7,100 shares issued. We issued an additional 6,400 shares. So that's what, 13,500. So we had to take the 13,500 times 10%. We're doing my math again. Times $15 per share. So that was the 13,500 times 10% times $15 per share to get the 20,250. The common stock, we issued 1350 at 8. It should work out right. Yeah. We had 10% of 13,500 is 1350. The par value is $8 per share. $8 times 1350 is 10,800, and then the paid-in capital in excess of par is the difference between the two. We purchased back some common or Treasury stock, and then we sold some Treasury stock at more than what we paid for it. We declared a 25-cent dividend on the outstanding shares of common stock. So for this one, we have to actually, I can't get my page to open like I want it to. Okay, so to come up with that number, we had the 13,500. We issued another 1350, right? We had the 13,500 outstanding. We issued another 1350 in the stock transaction. We purchased back, how many did we purchase back? We purchased back 800 shares, and then we sold, so minus 800 where we bought the Treasury stock, and then we sold 200 of those. So add 200 back. So we ended with 14,250 shares of stock outstanding, 25-cent per share dividend. $35.62, and it told us to round that to the nearest dollar in our instructions down here. And that's that. That's how that one works out. So I wanted to share that with you. The one other thing that I wanted to look at, I'm not sure what I have open here. Alrighty. Let me move this page over here. I wanted to show you real quick. I'm not sure. I hope some people are watching this because I know there's some panic over final exams moving forward in Blackboard. So if you go to your class sessions and class session 15, I want everyone to be aware, and I want you to start working on this. Under class session 15, you're going to have a study guide, a final exam study guide. You can use that to help prepare for your exam. If you haven't scheduled a proctor date yet for your exam, you'll want to get that done. And then you will have a review quiz that week, as well as making sure you do your discussion concept board, which is worth 30 points, and you will not want to miss those 30 points. So I wanted to point that out to you. Does anyone have any questions? If not, I'm going to end this webinar for tonight. You know, you can always let me know if you have questions, either by email or Blackboard IM, and I will answer those questions. Thank you.